We've got another stock market day and stream to do, folks. We finally have a green-looking day. Will it survive the dump that sometimes comes? We shall see. But so far, look at this. I mean, perfect, clean launch off of 595. You couldn't ask for a cleaner launch off of 595. Now, obviously, big thanks to Google for enabling that bounce. 5% on a $3 trillion company is like crazy. Also got to give credit where credit's due. Elon's pumping the chip talk. The chip talk helping Tesla get to 414. Struggling to break out of 414 just in the last 10-15 minutes here, but not unusual. 414 is a pretty strong, powerful line for Tesla here. Nice rocket ship from open to 414. And so now, it's a matter of, hey, can we hold some of these lines and slowly get back to, normal buy the dip and pushing everything back into a nice growth trajectory. We've had a little bit of pain, a little bit in the Qs. You can see the downtrend. The downtrend in the Qs is basically been going all month. People are like, oh my gosh, it's been a 3-week bear market. It's too long. It's too much bearing. It's time. We can't bear the bear market anymore. It's time for the bear market to end. And so a lot of people have been very frustrated about this bear market over here, and it's creating some nervousness. Is it liquidity? Is it private credit? What is it? Who knows? But today, what we really want to do is make sure we close above 595. The beginning of the day is typically defined by people buying the dip. Very, very common for people to get market open over here the first 2 hours. Oh, Google's up, buy more. Oh, Tesla's up, buy more. Very common. Now, what matters is once that buy the dipping is done within the first few hours, can we hold? So that'll be the tell today is will we be able to hold? Obviously, Bitcoin off of its lows over here got all the way down to 80.7, which is just above my, it's actually, it's a little chunk above. I got a line over here at, what is this, like 79.2. It's about $1,500 above the line. We had a bounce there, so not really sure what we bounced off over there. But anyway, see if we can hold this slow recovery. We can see it's not, this is the hour chart. It's not exactly the most violent, uptrend over here. If I go to the unaveraged candles for a moment, you can see this is, so far, a pretty puny start to an uptrend. It's not like a rocket like we've seen over here. It's more like this. Sometimes we break out of these with a strong rocket, but what we don't want is for this to be another one of these over here. You get a little bit of edging up, and then you just tank right back down. That's what we don't want, obviously. So we'll see. Today will be a good tell. You do have Nvidia that's really struggling. See some of the components that are struggling to hold it up. Nvidia is struggling a bit. Post earnings, not a lot of catalysts at the moment. If you look at it on even a forward peg basis, it's not exactly expensive. You could easily justify $300 on Nvidia. The problem is people are worried about growth rolling over, and of course that's going to destroy your peg. I saw Ross, good old Ross. I love Ross. He made a tweet yesterday. He said, "Hey, Nvidia's got a peg ratio of 0.8." And so this all comes down to like quick learning lesson for you in case you don't know. Everybody could have a different peg ratio based on what EPS they're using and what growth rates they're using. A lot of people use trailing growth rates, and on a trailing growth basis, of course, Nvidia looks like a god. I don't do that. I like to look at the future because my expectations for the future should align with the valuation that I have for the future. That's my take on fundamental analysis. So, for Nvidia, my forward peg is still like a 1.4 or whatever, and that's because I'm looking at forward growth rates. But if those forward growth rates collapse, it's not going to hold. It'll collapse. So, you could talk forecasts on price until you're blue in the face, but it's all predicated on that growth actually materializing. And I do have myself some concerns that maybe that growth won't materialize. continuously. To some extent, though, you are seeing some a pressure on NVIDIA because people are so excited about Google's TPUs. Like, oh my gosh, let's pay for Google because maybe they're the better chip maker. The chips are going to become the commodity in addition to LLMs. Like, LLMs and chips are just going to be the commodities. What really comes out of this AI boom are, you know, the goods and services. Well, really, they're all services. But it's the services that make us more productive and that actually make us money. That's what we're really excited about. And to some extent, LLMs do that. Okay, so what else? Let's go see what's in the news today. This will be fun. We'll go take a peek here. We've got not a lot of caddies. We do have a somewhat messed up week, though, this week with Black Friday because you have no stock market to trade on Thursday. So for Thanksgiving, we'll basically be off. And then on Friday, you have obviously Black Friday. You know, people are going to pay a lot of attention to retail sales data. Whatever. Odds of a Fed rate cut right now sit around 70%. Don't actually expect that to move very much. We've got the 10-2 Treasury curve sitting at 53. It's actually relaxing a bit today, which is nice. You know, chilling out again a little bit after the insanity that we had last week, which was hopefully just sort of like the final kiss, so to speak, of this 3-week downturn. I do think today is going to be a crucial determining day. And that determining day is really to say, can we keep it up? Like, we're up. The question is, can we keep it up? You know, our next line here is really 607. So 607 is what we're looking for. If we can get to 607, that's great. That'd be nice and bullish today. We've got another 1% to go in the Qs today. That would be almost people going full on risk again. Because to get a 2.7 day on the Qs, that's a big day on the Qs, 2.7. You know, we're at 1.7 right now. To get another percent in here, that would be very risk on. So that'd be good, you know, bullish. Like, I mean, I don't think anybody wins really. I mean, with the exception of a few people who are shorting, I don't think people win when the stock market collapses or falls. I mean, we haven't collapsed. We've just fallen a little bit, right? But people get frustrated. People get nervous. And I don't think anybody wins in that. So, especially if a stock market induces a recession, you know, that's just the most painful, you know, disaster. But I am watching to see if retail stocks can move the way we saw last Friday as a little bit of a risk indicator. Last Friday, we saw Target, for example, and Cheesecake and Chipotle. They actually all ran like 4 to 5%. You're not seeing that today, which to me suggests those were really just dead cat bounces. You know, Red Robin, Chipotle, Target, all of them are red right now. Macy's is red. Even Buster's got a little bit, up 71 bits. Cake is red. So to me, that sort of makes me feel Friday was a bit of a dead cat bounce on the retails. Doesn't exactly signal the most risk on, you know, attitude. We're a little tenuous. That's what it feels like. We're tenuous right now. We're waiting. We're not sure if we're going to be talking about.
Nice to have you. So you want to talk about lovemaking, right?
We're not sure if we're going to be, you know, on the bullish, exciting side or the scary, freaky.
You are not prepared.
So I mean, I guess we'll see. Private credit, obviously, that's the biggest concern right now. Why fears of a $1 trillion AI bubble are growing? Well, yeah, and obviously AI. I mean, this is the same article that they've been reposting and posting for like 5 days now. Every time I click on it, I see the same thumbnail. I'm like, oh, you got me to click on it again. So, Jinping presses Trump about Taiwan. Yeah, all right. Obviously, you got the NATO talk of an EU peace deal along with Trump's Ukraine deal, so we'll see what happens. You've got, you know, Russia will be getting a lot of land. They get that deal. I mean, that's kind of what Russia's wanted. They wanted their buffer territory and their energy-rich land for a while. So, let's see here. We've got Bitcoin weakness persists as crypto studies after bruising. These weird titles they come up with. Blue Owl is the sum of all investing fears. That is a great line. I totally agree with this. Blue Owl, by the way, remember, they're the company that I shouldn't say bailed out, but they're the company that is financing Meta's $27 billion deal. And so, Meta's actually up 3% right now. So they're financing, Meta's really gone on sale over here. Look at this. Like, if we get a risk-on rally, the fact that we're, like, now sitting on 607, pretty decent for Meta. You know, maybe this can actually start coming up again. But Blue, like, you have to actually love what Mark Zuck is doing. Mark Zuck is like, listen, we will build a $30 billion data center, but somebody else is going to hold the bag on it, and we get the right to cut and run every 4 years and pay like declining residual values if we need to bail on the contracts. It is brilliant deal making. I was actually surprised that Meta sold off after that deal making because I'm like, this is so smart. Meta is literally hedging themselves for an AI bubble popping, and the market is punishing them for that. And I'm like, whatever, that's great because it makes it cheaper if you want to buy it. But they're getting punished for brilliant deal making. And Blue Owl is the one holding back. Now, Blue Owl is actually a public stock. Blue Owl, that's the tech one. They've got a few different ticker. I think it's Owl is just that. Yeah, Blue Owl Capital. You know, these guys, especially since the Meta deal was announced, they've been tanking. I mean, look at this. They're down from 25 bucks. They're down, what, 13 divided by 25. They're down 43%. It's freaking crazy, dude. 43% on Blue Owl. Why? Because people look at this Blue Owl stock as the epitome of AI bubble risk. That's what people are looking at Blue Owl, you know? So you're kind of segmenting this over here. Nice. Qs keep going. Folks, this is good. You do not want this to dump today. Now, it's happened before. We've seen it last week. We saw it twice last week. 11 o'clock, which happens in about 30 minutes. You get the 11 a.m. dump. We'll see what happens. Hopefully not. But Tesla's now popping off over the 414 line. See how sustainable that is. Usually we end up rubber banding back to 414. So if you're playing calls on this, I certainly would have stops close to the 414 line, not personalized advice. All right, so Blue Owl is caught in a trifecta of market worries about private credit, AI, and the frothiness of wealthy individuals. Right, I mean, this is sort of or the flightiness. Oh. Hoping for alt asset managers. Okay, fine. Markets are in a grip of mass delusion is what the co-CEO says. Right. Guys, the CEO says the reason our stock is sold off is because everybody's delusional. Blue Owl stock, like the default protection derivatives on Oracle, looks like a decent hedge for today's trouble. Oh, so people are probably shorting the crap out of Blue Owl. Somebody says 11 a.m. is too late for a dump. Nah, man. Not paying attention, bro. You got to look at last week, man. You got to look at last week. Look at this. Two times. On the 19th and on the 20th. 11 a.m. dumps. Thursdays was bad. Wednesdays wasn't as bad. But you had dumps on both days at 11 o'clock. Here, the dump happened at an hour and a half later. Eastern time, right? 12:30. So, you know, to make the argument that, oh, that's too late for a dump to happen. Have you looked? You know, and I know this is Tesla, but you could look and align it with the Qs over here. So, like, if you look at the chart, it's literally what happened last week. So, you know, I don't think it's so easy to just cast that aside and be like, no, it can't happen. Well, it happened twice, 2 to 3 times last week. All right, what is this? Short interest has risen steadily since August, while declining or staying flat for listed private credit, like the others. According to data compiled by Bloomberg, the shares are down by a third since its recent peak. More than that now. Okay, look at all of them actually come down. You got a basket of trash over here. KKR, Ares, Blackstone, Apollo. Wow, look at all of them. Like, there's your hedge right here. That's actually kind of interesting. So if you want a hedge, I'm going to write those down. I love this. This is great. We should write this down. You should save this, or you could get it in the, oh, what are we going to call it? In the Meet Kevin app. So, private, oh, darn it. Private, oh, come on, Kevin. Private credit hedges. To guard against a collapse in AI and or private credit, short interest in stocks like Owl has been rising and private credit related names have been falling. Remember, we'll write that right here. Remember, Meta basically dumped their $30 billion data center risk onto Owl. Meta gets the benefits with 4-year escape clauses and prevents holding most of the bag. It's actually brilliant. Like, I thought the Meta, this IMO, brilliant risk management strategy by Meta. And I'm not even the biggest fan of Meta. I mean, I like the fact that they know how to make money with advertising. But it's not my favorite company. So, anyway, yeah. This is interesting. This has really been going on since September. Which makes sense, actually, because if you look at the peak, right? I mean, heck, let's look at that sheet. So, Tricolor was the 10th. And then what day was First Brands? First Brands was like the 20th, wasn't it? Let me see here. Tricolor. So Tricolor was, here it is. And then October 10th was crypto liquidation. Tricolor was September 28th. Yeah. So if we look at this chart and drop some arrows here, we can actually see this pretty clearly. September 10th, this was roughly Tricolor. And then First Brands was somewhere around here. So let's label those. Tricolor. Let's do it like this. Tricolor collapse. And then First Brands collapse was right here. First Brands collapse. And then we have, oops, if we go, there we go. October 10th was right here. This was the crypto liquidation, crypto 1010 event. And then, of course, you know, just whatever news since then. So, I mean, that's a little bit of a better, more detailed chart than what they had. So let's go ahead and slap that in here. But it gives you a potential vehicle for shorting. I'm not the biggest fan of shorting, mostly because I think our economy tends to, over time, bias up, not down. Which makes sense. And, okay, we'll call this the private credit. Okay, cool. So, let's see what else they're saying in that article. There we go. Okay, back to that article, which is right here. Why pick on Blue Owl? Wall Street analysts say almost all rate the stock a buy, but several characteristics stick out.
Something like
Oh my gosh. Why are you talking?
Again.
I'm not talking to you. More than half of its assets under management are in private credit. It's leaned strongly on data financing boom, helping Meta with their 30 bill project. Private credit has attracted a flood of negative headlines since Tricolor and First Brands, we know. Blah, blah, blah. Point. People work themselves into... This is what the CEO says. Are you kidding me? The co-CEO is literally bagging on people, bagging on private credit. Even though private credit is collapsing, you've got this right here. The point being, like, somehow, by just talking about this enough, people have worked themselves into this imaginary world where there's some bigger potential credit problem. Right. Let's just ignore all of the collapses that we've just seen. I mean, I think this guy is like borderline delusional. It makes me worried, actually. It kind of makes me think, like, this is exactly how 2008 went, where, you know, these CEOs are like, oh, guys, this isn't actually a problem. People are just being stupid. That's kind of how he's acting, right? So, Blue Owl co-CEO says private credit problems are imaginary. I guess he's ignoring. So what do we have that he's ignoring? He's ignoring, well, a lot of stuff. Let's see here. So tricolor. All right. There we go. So he's ignoring, we'll tweet it, 910 tricolor failure. You've got 0928 First Brands collapse. I've got crypto liquidation matters less. The UBS credit fund closure. The Renova Homes 100% loss. That was a good one. The Five Star Development bankruptcy on the 4th. I've got the Sonder Hotel Group bankruptcy. That's sort of like a good little list right there. Yeah. That's kind of interesting. That's just the sample too. That's wild. All right. Okay. Fine. I'm not sure true default rates, losses, let's see here. But the problem with private credit and name, with little transparency, investors have no choice but to draw their own pictures of the details. Yeah. Twice this year, private credit funds have gone. What is this? To be clear, Zipcars, Renova Homes were part of Blue Owl, but cases illustrate uncertainty in cases of lending. Well, I don't even know this one. What's Zip Car Wash? Let's see what happened here. News. Successful emergence from financial restructuring. Bankruptcy. Oh, that was in February. Oh, interesting.
Sorry, something went wrong.
Stop
Please try
talking.
again.
What is this? Oh, it's an Apple device. Stop talking to me. Like, shut up. Siri for you. Shut up. There. God, I hate that. All right, so AI dumb. It's like dumb AI. All right, so what we have here: Zip Car Wash, privately held car wash operators announced successful restructuring Chapter 11 process. So this was earlier this year, and I guess they restructured. So what was it, like $270-something million in debt that they got rid of? All right. So, good. Queues keep running. Got about 15 minutes to 11 a.m. Eastern. So, hopefully things keep going nicely here. Volumes pretty typical. Declining volumes as that sort of buy the dip ammunition slows a little bit. Not uncommon. You actually got NVIDIA gain the lead.
Gain the lead.
That's nice. Little recovery there on NVIDIA. Good. Meta's got a nice bounce over here. Very nice. Even Blue Owl's up a little bit today. Bitcoin, very good. Keeps going. So that's good. 86.5 right now. What wasn't it like last night? Didn't we get up to 88? Yeah. Look at this. Last night we got up to 88. But you're still higher than where you were on Friday. So that's good. All right, let's see here. What else do we have? Let's go over. Let's see here. We have Bitcoin, boring. Blue Owl, talked about that. AI is likely to clear labor shortages, blah, blah, blah. Target needs more than a vibe shift to turn the business around. Case against social media, blah, blah, blah. Boring, boring, boring. All right. Let's go take a peek. Ooh, I'm gonna close that door. It sounds like the babies have arrived downstairs. I hear that. Close the door. All right, inside. Oh, look at this, Sonder. Inside Marriott's disaster bet. Oh, it'd be so cool to see what happened over here if they have some insights on why this blew up, because this is a private credit example right here, right? Yeah. Somebody says, any historical precedents, a surprise jobs report before the Fed meeting? No. Typically, the Bureau of Labor Statistics gives you, and they've done this in prior shutdowns before, where they give you, they'll say like, hey, we're going to announce when we're going to release the data. So typically, you're not going to get some kind of rather like crazy surprise there. Typically not. So somebody says, sounds like people are catching on that GPT isn't the best game in town. Yeah, no, that's true. Let's see here. Cool. Okay, just looking at it. Somebody says this is just manipulation and gambling at this point. I don't think so. I think there are plenty of things to buy the dip on. We've got a list of 10 stocks I like buying for the next 10 years. What I'm buying in those, I'm holding for the next 10 years. Come hell or high water, it doesn't matter. Yeah. All right, let's go see. Okay, how do you access the Alpha Report? You watch lecture 1.0. So when you sign up, you watch the very first lecture, and it gives you like a 10-minute breakdown of how to join. You don't even need the 10 minutes, because the first 30 seconds explain it, but then the next 9 minutes and 30 seconds are in the event that you need some more help. But yeah, watch lecture 1.0. It'll take care of you. For Marriott International, $15 million seemed like a low-risk way to add 9,000 rooms to its global portfolio. So last year, they struck a licensing agreement with the upstart short-term rental company called Sonder, whose twist on Airbnb-style booking was to provide guests with hotel amenities at apartment-like units. Ugh. Gosh, what a pain, man. That sounds horrible. Marriott customers who earned loyalty points by booking at Sonder liked the option to add a few thousand. Then a puzzling email arrived from Marriott. We are kindly requesting that you check out of the property as soon as you're able to. Oh, this is the customer point of view. Everything went downhill from there. Hospitality manager. Digital room keys were deactivating, locking people out of their rooms with their belongings inside. Guests who lived in Sonder properties for months or even years inundated front desk workers with questions, even approaching the police about eviction laws. 24 hours after the email went out, Sonder said it planned to liquidate the company after more than a decade in business. It collapsed under the weight of costly long-term property leases without enough revenues from customers to cover them. Well, it's always debt, boys and girls. It's always debt. It's always debt. Oh my gosh, it's scary. This is why, I love the idea of, and I want to keep sharing that journey with y'all, but I love that we're growing HouseHack without debt. Even our AI product, we're launching that in December. We'll have an announcement on that this week because we're gonna have a couple pricing plans coming out for it, which will be really cool, including a lifetime access. Especially since it's in beta, but it's sort of going to be like an early access, especially for course members and that. But it'll be really cool. We've got, I think, a really great product in the works, and it's going to be awesome because in the future, I actually think our product could probably cost somewhere around $200 a month, especially for agents. Like the value is going to be so high in terms of how it could boost people's net worth in real estate. So I think the value is tens of thousands to hundreds of thousands of dollars for users of tangible AI value. So I think $200 a month is a drop in the bucket. But we'll start with some kind of lifetime access for people. Probably a 2-year option and then a lifetime option. So there'll be 2 different prices there. But we'll probably start with that hopefully this week. And I'm pretty excited about that. So stay tuned for more on that. That'll be fun. I don't. How did I get on that topic? I don't know how I got on that topic. Oh, because of debt, and we're not. Oh yeah. Because the point is, like, also, if we sell lifetime access to people who join early, you're getting like a massively discounted price. But then it also gives us cash to reinvest into even more of the AI product itself. So it makes sure that we can constantly buy real estate and finance, basically pay for AI without any financing. It's really great. Chaotic, and so as a result, we want to reward people who join early, obviously. Because if the product costs $200 a month, January 2027, and Househack wants to IPO, and you got a lifetime membership at the end of 2025, damn, that product's gonna look good, for you. So chaotic unraveling. Okay, shock gas, blah blah blah. All right, days later, Sonder said it attempted to sell itself, but the deal fell through. Well, there's no money right now to go buy Sonder hotels. Come on, man. Marriott pulled the plug because it defaulted on Stern. What's the breaking news?
Confirmation now from both sides on this call that happened this morning between Chinese leader Xi Jinping and President Donald Trump at the White House. Both sides in Beijing and Washington now confirming that the call took place. Not a whole lot of detail here, Carl, but the Chinese readout from their foreign ministry provided to us by our Eunice Yoon in Beijing suggests that the two men discussed both Ukraine and Taiwan in that call. Fairly diplomatic language here in the readout, but both of those topics did come up. And given that the president, Sarah, has been engaged in this diplomatic effort around ending the Ukraine-Russian war, you do wonder what was said between these two leaders in terms of China's relation.
Yeah, okay, so you know nothing. You know nothing. There's no breaking news. This is stupid. Oh, man. Yeah. Somebody says, odds for an interest rate cut jump Friday. Yeah, we made a whole video on that. Is that like a little AI summary or a tweet or something? But yeah, no, I mean, we know that. We did a video first thing Friday morning. We're like, oh my gosh, this is great. But you still had a rough ride on Friday, So, we'll see. We'll see. All right, so Marriott said it pulled the plug on the partnership because Sonder defaulted on the terms. Blah, 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 blah. Okay. All right. Let's see if there's... I want to see severe financial constraints. Let's see here. Sonder, co-founder, idea came to him in 20... who cares? Two companies sparring bankruptcy, threatening to shut down, blah, blah, blah. They blame bookings. Sonder leased properties and then rented they were a releasing company is what it was. This is great during COVID. It's terrible though. Yeah, it's like WeWork, right? Rapid growth. I don't care. I want to know how they fell. It's gonna be debt. The unraveling. It's always debt, folks. Always. Debt. So let's see here. Okay, yeah, 70.6% chance of a rate cut right now. I just pulled that. Sonder was still pressed for cash. Once again, sought help from Marriott. Agreed to convert its fees into a new loan. Oh, okay, great, yeah. They thought they would negotiate deals with landlords to terminate leases in deals where in buildings where it was losing money. He said owners asked Casa to manage rooms in about a dozen former hotels, Sonder properties. Sonder was using the wrong business model, blah, blah, blah. Sonder missed their financial report. Oh, that's great. Postponed their annual shareholder meeting. Missed their financial report. On Halloween, they announced potential layoffs. Employees were summoned to an all-hands meeting. Managers expressed optimism that they would soon be on solid ground, that there was nothing to worry about. we just have to say, guys, like, we just have to let everybody know that the ship is on fire, but don't worry, there's absolutely no reason to panic. 9 days later, Marriott sent out emails asking guests to vacate. Wow, just 9 days later, they go BK. Wow. Let's see here. Making the booking, blah, blah, blah. Confusion mounted. Slack channels started closing down. Oh my gosh. One of the guy's general managers changed his LinkedIn profile to reflect that he was open to work. Oh my gosh. This is just like a collapse in real time. Said employees were asked to tell customers that Sonder was no longer operating as a hotel, and guests should reach out to Marriott or third-party booking platforms. Wow, what a disaster. Termination notices, working with prospective investors on a potential sale, but that anticipated financing was suddenly and unexpectedly no longer available. Hey, maybe we could get bailed out. JK, we can't get bailed out. So it literally goes from everything is fine to we're bankrupt. I mean, that's always how it is. They all, it almost feels like if you look at any company's collapse, someone at the company always says everything is fine right before the collapse. Let's see here. $2.2 million severance package. Yeah, no kidding. Idiots threw money at this moron. SPAC deals. Ugh. Was this a SPAC deal? Yeah, this is the thing. People growing a business without debt is really hard for people. Really hard. You know, everybody always wants to get on the nipple of debt, and then they don't know how to manage it. You know, and then all of a sudden interest rates go up, revenue slowed down, growth slows down, new funding slows down. Then you fail. Yeah, but then that's also why, I hate to say it, but it's one of the reasons why recessions are actually good, because it lowers the cost of everything that's gotten really expensive. You know, recessions are very deflationary, and it takes the froth out. Just kills the nasty froth. Blech. The billionaire who made California unaffordable? Oh, there's a line. All right, it's 11 a.m. Are we going to get the 11 a.m. dump? We got it 2 days last week. So we'll see. Tom Steyer, former hedge fund manager turned climate activist, kicked off his campaign for California governor. Tom who? San Francisco billionaire. It's likely thanks to his batty climate-focused campaign in the Democratic presidential nomination in 2022, where he spent $4,600 for every vote he received. Dude, when I ran for governor, we spent less than $1 per vote we received. Less than $1. Gavin Newsom spent like $5 per vote. This guy spent $4,600 per vote? What a moron. Wow. Yacht load of money promoting himself. Even so, his new campaign exemplifies today's progressive elite's lack of introspection. The campaign launch video, he indicts Newsom. Californians deserve a life they can afford, but Californians who make the state run are being overrun by the cost. Blah, blah, blah. Okay. Let's see here. Cap and trade program. Okay, so he's been anti-cap and trade programs in the past. So now they're so what the Wall Street Journal is saying, he's basically campaigned against propositions that would have made California potentially more affordable. But, you know, now ironically, he's running on affordability. The ultimate climate hypocrite made much of his fortune investing in fossil fuels. Now, he wants to warn about global warming to grab political power. Typical Democrat. Oh. When the Bolsheviks took Russia, they seized the freedom, wealth, and property of those who had it. Resistors were killed. Liberalism leads to socialism, leads to communism. They are rotten to the core. Illiberalism leads to socialism, to communism. I would posit. Who writes this? I would posit. With the semicolon too? Liberalism, in a true sense, is good for all, including true conservatives. All right. Playing definition games here. This is when you know it's a boring day. All right, so where are we? Where's the information today? So the information, the twins pushing Elon's plans to replace X staff with Grok. What? The comments are the best. Yeah, exactly. What do we got here? Last month, Elon Musk laid off half of the engineering team tasked with fighting spam. Okay. What do they cut it, replacing with Grok? Team has been whittled down to less than 20 people before the layoffs. Oh, that was before. Compared to 100 when Musk acquired the company. Oh my gosh. Okay. The layoffs were the desire to replace X's engineer systems as much as possible with Grok. Right. To oversee the transition, Musk has installed 2 engineers from xAI, twins from Ukraine, Dima and Ivgen. Dima and Ivgen. All right. So if you're wondering what's going on with spam fighting, Dima and Ivan are at the helm. The twins have effectively become top engineers at the site since OpenAI poached X's previous leaders, blah, blah, blah. Separately, bloody, bloody, bloody. They run classic Musk playbook, ordering engineers into the office for long hours and on weekends, rooting out inefficiencies and moving quickly to cut roles deemed ineffective. I mean, saving money is very important for them because I think Elon needs money right now. I hate saying that. And I think that's why he's so reliant on kind of like pumping Tesla stock right now, because they're blowing as much money as they possibly can on xAI because he wants to beat Sam Altman. So some of this is ego, but they need money. So it's not a surprise that they're cutting. And then it's like, hey, if we're investing this much in chips, can we use the chips to do the job that people are doing? That makes sense. All right. Grok concerns. Yeah. I mean, Grok can have some biases. Grok just the other day was saying there are 200 robotaxis on the road, and they're really only like 200, or they're only 20. No, I think we're at 30 robotaxis on the road right now with Tesla. And so I think some of Grok like picks up evidence from people's speculation on X, which probably isn't the best way to train an AI model by picking up on speculation on X, but hey, we'll see. Why OpenAI should worry about Google's pre-training prowess? Ooh, Gemini 3. We might particularly worry about Altman. What might particularly worry Altman about Google's latest model is how the tech company, how Google's Gemini got so good in the first place, specifically through improvements in pre-training. Not only is pre-training an area where OpenAI has recently struggled, but many researchers believe that improving pre-training is the key to getting the model to better generalize. I totally agree with that. The more patterns the model sees on the, in pre-training, the better it is going to do in the back end. And this is why I'm always a fan of like more training, more data, more data. And it's really critical. As soon as you stop training in the front or like in the pre-training side, you're killing the product in the end. At the backside. That's my belief. Pre-training refers to the first phase when the researchers expose the model to new data sets or whatever. That's fine. Many researchers argue pre-training generalizes better. Blah blah blah. Post-training builds off the foundation. Yeah, but this introduces noise. Post-training is dangerous. Like when you're relying on an AI to train itself, you're going to have a very, very noisy algorithm because it just amplifies the errors over and over and over again. It's like making a copy, like taking a piece of paper or a picture and making a copy on a copy machine and then making a new copy and a new copy and a new copy. All the little specks that you don't notice in the first copy become really evident by like the 10th copy. It's really bad for AI. So if Google can do better pre-training, yeah, totally makes sense why their model would improve. So like, I think if you're doing anything with AI, you have to keep training to stay ahead of your competition at the front end. Otherwise, you're just going to fall behind. And we do that at HouseHack. That's my priority. Every day, I'm like, I want more pre-training. I do most of the pre-training. Because the whole point is that our HouseHack AI algo is like, it's like what we want it to be is like Kevin in your pocket, right? So like, imagine this, you open up an app and it's like, hey, out of the 100 listings in your area, Kevin says, look at these 5 first. And then, you know, as we build out the features next year, you know, you open it up and you're like, oh, Kevin thinks my net worth will go up by 100 grand on that one, 80 grand on that one. And if I buy that one, my net worth would go down by 30 grand. Like, think about having that sticker or label on every real estate listing that's out there. It's like Kevin's AI opinion. Like, this is a crap deal, bro. This is a good deal. Or like you click on it, it's like, here's how you should renovate the property according to Kevin's AI. Like, we're really stoked about that. That's why we want to do we're going to do like a 2-year pricing plan and then a lifetime access plan. But once the features out, because the features aren't all out yet, but once the features are out, there won't be a lifetime access plan. We think it's going to be like, you know, $200 a month or whatever. People will turn it on or off as they need it. But the lifetime access plan will be really clutch. Education department gave, it's like a net worth skyrocketing tool. You know, somebody gave you a tool. It's like, here's 50 grand in your pocket. You know, that's nice. It's net worth sniper. That's what we should call it. Boom, 50 grand. Boom, 50 grand. That's like HouseHack. Yeah, I love it. All right, so what we got over here? Let's see here. Education department gave another boring. Where's the news today? All right, what's going on with the sticks? Hey, so far, no dumpy. This is a good. This is great. That's bullish. It's now 11:09 Eastern. Woo! HouseHack AI is our own proprietary ML, but we use, we combine, I mean, anytime you have artificial intelligence, you should be using a variety. So multiple different MLs, some LLMs can serve small purposes, but the vast majority is just proprietary training of your own MLs. So, very cool. So let's see here. Tesla, yeah, look at this. No dumpy. So Tesla, nice little run right here. We got 417. Look at that. Right on the 414 line. This is actually pretty impressive. We'll have an affiliate program or sales program. People can sell your house. We should. I mean, it's not a bad idea. You know, you do like a 20% or something like that, affiliate link or whatever. Yeah, we could probably do something like that. You know what? I'll make a note of that because I think what'll happen, like our community is out of the total addressable market for people who could use this, 4 million home buyers every single year. Every single year in America, 4 to 6 million homes are sold. So out of that market, what's our initial reach going to be for the app? A few thousand or whatever our initial reach is. So that's why we think if we give our founding members lifetime access with some really sick deal on the AI, as we build it out over the rest of the next year or so, we hope that this expands to tens to hundreds of thousands of users. And then we go IPO HouseHack, but all the founding members will have lifetime access. So that's affiliate deal. I'm going to write that down. I'm going to write down 20% affiliate. I'll put that down. Affiliate. HH. Yeah, I'll put some thought into that. Yeah. So, very cool. Let's see here. Okay. Sonny says, Kevin says a recession is good to help bring prices down, but is happy to see the market pump for no reason. Kevin is secretly impermeable. Well, I think what you have to understand is recessions are very painful for people. If you have like some shorts and you're like pissed and you got a stick up your ass today and you're like, let me dump on Kevin for being bullish. because the market is not dumping at 11 and the market's bouncing off 595 on the Qs, and it is actually short-term technical bullish, and you have a stick up your butt because, you know, your shorts are getting burned, well, first of all, sucks for you. Second of all, let's be very clear. Recessions are good and deflationary. They bring prices down. They make it more affordable to buy stocks or goods and services. But they're very painful because people lose their jobs, right? People lose their jobs. They lose their livelihood. You know, people die. Divorce happens. Households fall apart. Recessions are very, very sad. So I'm very sad about that. Somebody here says, okay, this is a really good question. Can the AI help us with something you already own? So one of the products that we're building for the AI, or will be building in 26, because we're going to have like a really early rudimentary beta. It's going to be super early. But one of the products that I want to build out for 26 is where you can upload your own pictures. So like, let's say you own a property, right? And you're like, all right, Kevin, show me what you got. And you're like, help me remodel this kitchen. What I would love is for our app, you take pictures of your kitchen and you basically get Kevin, the AI mentor, going, look, man, here's exactly how you should remodel the kitchen. Here's what design you should use. Here are the timeless choices you should make. Here's how much you should budget based on where your location is. And if you spend this much, here's how your net worth could be positive. But if you spend this much, here's how your net worth could be negative. Like, that's hard AI to build, but we can do it. Like, from what I've already seen, I know we can do it. And nobody else is doing this, so it's really exciting. And that'll be something that comes as well. And again, as those features come out, like, you know, the cost is just gonna, for people who want to buy it, is gonna skyrocket. And then we're gonna IPO this puppy is my goal. So, you know, no guarantees, of course, but that's my goal. And this is also why I would love the market to just rebound too, because I think we launch our AI, foundation people join, and then we build out the suite, hopefully over the first 3 to 6 months of 2026, and then we IPO the sucker in a boom market, in a bull market. That would be the dream. If I had a crystal ball, well, not a crystal ball, if I had like a genie in a bottle, I would be like, let all of our AI be perfect within the first 6 months so we can IPO at the end of the summer in 26. I don't know, or early 27 or whatever, right? That would be great. You know, it'd be bad if we fell into a recession. I mean, we'll still build our AI, but it's not going to be a frothy IPO market, you know? Look at this, NVIDIA, nice 1% over here. So, are founders house hack investors? I don't know what that means. No, when I'm saying founders, I'm saying like, we're going to start selling access to the AI. We'll offer a 2-year plan and a lifetime plan. And you basically get in at a founding price is what I'm saying. Okay, good. So market staying green. No 11 a.m. sell-off. Good. So let's see what we have here. Okay, so BBC, Trump hints at big progress. No one will support it. Ukraine soldiers react to peace plan. Yeah, we'll see. Trump hints at big progress in talks. Okay, no real news there. So what do we got at the FT? Chinese exporters charge Russia more for war supplies. Affordability is Trump's problem now. Yeah. Nice. Okay, 19-point police plan. Defer the biggest decisions. U.S. and Ukraine draft new 19-point plan. It's interesting. Oh, did House Hack Tesla rip even more here? Yeah, I mean, it's bouncing off the 414. It's at 7.25 right now, which is great. And so far, the market keeps moving up. There's been no down on this. We did have a hint this morning. This was the first morning that Bitcoin was actually higher than where it has been over like really the last 3 weeks. If you look mostly, it's been lower. And this is the first time Bitcoin was higher than where it was, in the prior trading day in a while. And so it's turning out to be quite a bullish day here. I mean, AMD's at 212. Tesla smashed the 414. You've got the retail stocks not doing great. Bond yields are down. I mean, this is how the world should be. Bond yields are down. You know, Tesla rebounding. The Qs rebounding. This is great. We actually might be able to get to 607 today. We're 4 points. We're 40 basis points and $4 away from 6.7. 607. Very cool. Very cool. So, yeah, drone operators asking about foundation model. This is a foundation model. So what we have is our ML is a foundation model. We're not like, you know, we're not a wrapper. You know, HouseHack AI is not some bullshit wrapper. We literally, this is our AI ground up. It is a foundation model of real estate. And that's what's really exciting because it just doesn't exist right now. Nobody else is doing it. And I think most people in AI don't understand real estate either. I know that's okay. It's not to bag on it. But I think we have this insane head start. I mean, we were building our foundation model starting back in 2018. So, you know, we've been on this for a while. Okay, so the info, Sackdell thinks he can solve America's energy crisis. Cool, cute. Okay, the information doesn't have anything for us. We've got anything over here? Not really. Kind of quiet. You know, there is a piece I do want to cover. So let's go to... Okay, where is it? It was this article. Okay, this person wrote yesterday, "My life is a lie." All right, so what do we have here? Yeah, we're doing beta signups this week, so stay tuned. Not yet on the HouseHack AI. We're going to, and then it'll release in December. Like the beta, it's early beta. Early beta will release here in December, and then as features come out, we're gonna raise the price. Like we will probably 10x the price of the product over the next year. But this, you know, this week and next week or so, we expect people will be able to buy a foundation membership. So thanks for asking about it, but that's the plan. Anyway, we're going to largely skip markets again because the sweater is rapidly unraveling in other areas I pull on the chart. Suffice to say, the market is largely unfolding. Suffice to say that the market is largely unfolding. Credit stress is rising, particularly in the tech sector. Well, we got a big old pump in the markets today, homie. Many are pointing to CDSs as the rise, Oracle CDSs, but CDS is also just introduced for Meta. Traded slightly worse. Okay, so we're looking at CDSs now on Meta as well. Okay. When you say AI, how is it not different than traditional ML and computer vision? You gotta be careful throwing around these words. You have to understand, anybody can make an ML, a machine learning algorithm. That's all it is, they're algorithm, right? Anybody can make one. What makes it unique and proprietary is the data and the input data. It's not like an on and off switch. You have to sit there for years and train the damn data. You want to go do that, go do it. But how you train and tune an algorithm, that's what makes your ML unique over other people's. You know, so it's the same thing as like Gemini and OpenAI. They build a foundation model and then they tweak weights and their algorithm. They try to pre-train more. It's the same thing the HouseHack's doing on a way smaller scale. We're not trying to do a world model on the whole world like those chatbots are doing. We just want just real estate. Just the interiors right now of real estate. That's it. Very, very different. Kitchens, bathrooms, living rooms, basements, right? Location. Like these are all valuation. Like this is so different. Is there any place to read up on HouseHack AI products? Yeah, just go to go to househack.com or reinvest.co. Because if you go to it, you can actually see some samples of the AI product and sort of our roadmap, right? private alpha access, because like here in December, it's going to be really, really early. We'll do beta access, valuation, renovation, advanced AI. You know, you could see it at reinvest.co. Okay, where were we? We were just looking at, that guy's Substack or whatever. Right, okay. Market pricing of a correlation is beginning to pick up. Remember, this is real fear index. Yeah, this is just CDS. As a pretty, I mean, to some extent, I think people are also in hedging, right? So, like, just because you see Oracle CDSs go up doesn't mean everything is falling. What it means is people are hedging, right? It's just going to be U.S. first at first, but you know, eventually we'll try to go to international markets. So let's see here. Okay, so broken benchmark. Okay, this guy, so far, this is all just talk. Markets liquidity. Okay, talk about liquidity. Let's see here. We've got U.S. poverty line. What is this? Measurement failure. This is so much yapping and talking. Okay, real math of survival. The official poverty rate for a family of 4 is $31,000. The median household income is roughly $80,000. $80,000 should mean you're doing fine, but I wanted to see what would happen if I ignored the official stats and simply calculated the cost of living. So, you require $136,000 not to feel poor, basically. Yeah, that's probably not true if you have, or not untrue if you have children then. Housing Live, Real America, they're talking about poverty rates, blah, blah, blah. Why phone costs $200, not $58, blah, blah, blah. Okay, whatever. This is too boring for me. This is like some, you know, philosophical bull crap. So, you know what's probably also happening today? Some level of a short squeeze. Because look at this. This is the, unless this was because of the reverse split. I don't know. Fund flow. This says fund flows. This says billions of dollars of fund flows into SQQQ. So if this is true, $12 billion of net inflows on Thursday, you had a massive short position basically go into the market on Thursday, or starting at around 11 o'clock, right? So look at the day chart. Here's your 11 o'clock sell-off on Thursday. Disaster, right? Very disastrous right here. And, you know, what's interesting is it is probably driven by shorts. Very fascinating. Okay, let's see here. Then Tesla, it just needs to hold 414 today. I wouldn't get greedy about needing to be like way higher. Just holding 414 is a win for it today, honestly. Win, win, win. D-Boy Swag says, Yo, Kev, how does one get access to the Meet Kevin Alpha Board? MeetKevin.com. But there's no coupon right now. So you can email us at...
Email staff at meetkevin.com.
But yeah, there's no coupon right now. So, yeah, good questions, though. Good questions here. All right, good. Somebody here says, this is a trap. Small and mid-cap stocks have not moved for 5 years. Okay, let's try IWM. So IWM, if I go out on the week chart, I mean, you know, go to the month chart. I mean, these are mid caps. I mean, you're basically trying to refer back over here, 222. Yeah, I mean, you're up 10% in like 5 years on IWM if you kind of go peak to peak, right? I get that. I get that frustration. Well, I think there's just a bifurcation in the market where it's basically what you have is classic capitalism. The rich get richer and the poor get poorer. You know, it's unfortunate. What is AI has always... Okay, you're saying... blah, blah, blah. Yeah, no, I agree. Like, AI is really just the buzzword today. But remember, AI is just big data, right? That's not sexy. Like, big data, neural nets, machine learning, put all of that into a little cup. You know, you take a little Pokemon cup, put in machine learning, language models, whatever, neural nets, big data. You put it all into a cup, and then you brand the cup AI. That's basically it. It's like the most consumer-friendly label. And it's not really artificial intelligence. Like, there's nothing artificial about it because it's really understanding the patterns of a worldview and then generating ideas from that worldview. Okay, so anything that's being generated is being generated from things that already exist, right? So like if we're like, picture a cat on Mars. Well, we don't know what a cat on Mars actually looks like, but we know what a cat looks like, and we know what Mars looks like, and we know what, how gravity functions. So we can put that together and we can deduce, like in your head right now, if you thought, picture a cat on Mars, you could picture it. Maybe not with the greatest of detail, but you could roughly picture it. And that's really what Gen AI is. So really, it's really incredible pattern recognition that then can generate from those patterns new ideas. And that's what's really so incredible about it. Is it really artificial intelligence? Not really. Not really. I agree with that. I think most of that is just a buzzword. Most of that is marketing. But that doesn't mean it's not useful, right? So, I mean, like, Tesla's FSD is fantastic. I've been using it since 2017. I'm an 8-year veteran of FSD, if you will. And, I hate driving other cars because they don't have FSD. I love FSD. It's the best product in the world. Now, am I going to pay 5 or 6 peg for Tesla because of that? No, of course not. It's very expensive, the stock right now. Very expensive. Now, I still have some, Tesla stock exposure. And I'm grateful it's up. Don't get me wrong. But I'm not going to add more at those prices. Oh, look at this. Google is actually slowly bleeding here. That's very interesting. Google peaked out about an hour and a half ago. So Google peaked out an hour and a half ago. Apple's right at the line, the 274 line. Very interesting. Yeah, very interesting. So, a bunch of people say, we need a coupon code. Guys, there's no code right now. Stop it. Yeah, okay, AMD's really doing nicely. Remember, we want the 232 line. That's how we could restore a bull market. It's 232. So, okay, let's see what else is going on. All right. So, let's see here. Let's see, back to the Doomshurst here. And then let me hit, let's see here. Let's see what the suits are saying. Because the suits have a live blog going in the back end. And I want to see if there's anything juicy over there. So far, pretty chill day. And after I look at this, we'll go look at some publications as well. So it says, Treasury 2 years starting to garner support. That's cool. Treasuries to build on rally with labor concerns mounting. Well, yeah. Treasuries look set to extend their rally ahead of Wednesday's beige book, with the market seeking anecdotal evidence that could confirm a December rate cut. 10-year drifted lower. Yeah, I think the 10-year coming down because of labor concerns is very realistic and an understandable hedge. It's been a very poorly performing hedge, but it's understandable. I mean, in fairness, though, bonds have returned more money over the last year than Bitcoin has. And actually, I think on TLT, that's negative over the last year. But let's see. I could be wrong about that. TLT, 1 year. Oh, that's -2. And then Bitcoin, 1 year, 11%. Yeah, Bitcoin is down 11% on the year. This means that the 25-year average maturity of TLT has outperformed Bitcoin to the tune of 8% and provided you a dividend, right? Because if you actually look at TLT, the dividend on TLT is 4.3%. So with the dividend, TLT is actually positive over the last 12 months, where Bitcoin is a negative 11%. So you're positive 1% on TLT, negative 11 on Bitcoin. Like, I'm not trying to bag on Bitcoin. I'm just saying that's embarrassing. That sucks, because it's like bonds have done shit. Okay, they've been terrible, and Bitcoin has done worse than that over the last 12 months. That's a lot. So hopefully that this is just a consolidation, and we can get sort of back to a risk-on rally. You always talk about AMD 232 indicator. Can you explain why that line is so crucial? Yeah, I can. So after Lisa Su adjusted her forecasts on chip development and chip growth, which is only 46% of AMD, right? You have to remember that. Only 46% of AMD is data centers. 89% of NVIDIA is data centers, which means AMD has a lot more room to grow margins if they grow that data center side. So Lisa Su went mega bullish on these, and the day after that, we ran to 232. Now, we've since extended past, but we've always rubber banded back down. So if you look at AMD and zoom out, see this right here? 232, that right here, that's the candle. We ran up to 232. We played 232 for like 14 days. Then we bounce off of 232 only to come back to 232 to bounce off it again, to run again, to fall again. Losing 232 is bearish, because now what you're actually doing is you are slowly unpricing all of that enthusiasm for AMD chips. You actually, the more this falls under 232, the more I want to buy AMD. Because listen, here's my thesis on AMD, okay? AMD has substantially weaker margins than NVIDIA. NVIDIA brings like 55 cents out of every dollar to the bottom line. AMD brings like 13 cents to the bottom line. Part of that is because more than half of their business is still commoditized crap. Gaming chips, whatever, right? CPUs, lower margin products. If they get into data center space and they increase their exposure there, and that becomes a bigger part of their business, their net income is going to skyrocket, as long as AI chip sales hold up. If data center chip sales start slowing down because the funding dries up, XAI can't get funding, CoreWeave can't get funding, NBIS, IREN, if all these companies can't get funding, then they can't buy chips anymore. Then Elon's going to have to sell Tesla stock or margin Tesla stock to buy more chips at XAI. That's when you're getting to the end of the cycle. And that's what people are worried about, is like, do we still have the funding capacity to buy these chips on debt? That's all it is. NVIDIA is like a bank, It's like we take $10 and we turn it into $100 of chip sales by this circular investing. But the only reason that circular investing happens is because people are willing to lend the other $90. So $10 invested turns into $90 of financing. That works as long as people believe it. Once that cycle stops, you stop seeing chip sales. So that's the problem. That's the problem here. Now, personally, the buying opportunity here is if AMD goes down back to like 173, right? So you go back to the 173 line, or 162, that's a big spot too. You go back into that little range right there. If we still have AI data center growth and we're back at those levels, you're starting to get to like back up the truck levels for the stock. The problem is, are you gonna be at those levels and then be like, oh, but crap, we're starting to see the financing cycle come to an end for AI chips? Well, then there's no floor. If the AI financing cycle dies, there is no floor for these stocks. The floor falls out from AMD, from NVIDIA, all of it. It's all crap. Meet Graham has a coupon code. Meet Graham. I love Graham. I saw he had a lot of issues with LA. I feel bad for that. So somebody says, what kind of... Kevin, check the news today. Something's off. I don't know what you're saying. Something's off. Somebody says my opinion on MicroStrategy. Yeah, I don't know, man. There's been so much misinformation and crap about MicroStrategy, like getting kicked out of the indices. I don't really know what to believe over there. I expect some of it is fake news. But I'm also just not the biggest fan of MicroStrategy. But I've made that pretty clear. I will say, I never thought I would agree with Michael Saylor on anything, but they've got like this whole crusade against JP Morgan right now, and I ship it. I'm like, this is great. I fracking hate JP Morgan, and like, you don't hate the big banks enough. I really think the big banks, because they're too big to fail, they think they're, they don't have to innovate on their products. We've saved so much time and money switching to different banks. I'm not even here to shill a different bank. I don't care. But even like, and again, it's not to shill it. I even love what I see at SoFi, because I have SoFi as well. I mean, just the innovation and quality you get at these different companies is so much better than the big banks. And I see like the Tricolor collapse, this whole private credit collapse happen. It's ironic, right? But Tricolor collapses because JP Morgan pulls their $700 million line of credit. And then Jamie Dimon comes out and goes, oh, when there's one cockroach, there are more. But you're the one that like created the first cockroach. So are you actually to blame? Are you the one who's releasing the cockroaches? It feels shystery. Like, I don't think he stepped on the first cockroach. I think he's the guy. Like, he's secretly got a box of cockroaches. Because I just think they're shysters. That's my opinion. I could be wrong. I think he's got a box of cockroaches. And he's like, he's doing this over here. But then he's talking to Bloomberg over here going, yeah, guys, there are cockroaches out there. You guys got to be careful. Here, cockroach. Here, more cockroach. Like, that's how I just see him as, like, evil. I'm sorry. I don't trust these bankers at all. But I think that's what they do. It's like, on one hand, they'll set up, shorts or puts or hedges or whatever because the cockroaches are coming. And they're the ones releasing the cockroaches. Like, they enabled shystery financing. So it's kind of like, it's almost like this. So, guys, we're going long. And then you turn around and you give a bunch of stupid companies massive lines of credit. And then you go, guys, we're going short. And then all you have to do is pull the lines of credit from those companies and you engineer a private credit crash. Like, how is that not shystery? I don't know. I got to get off the JP Morgan topic. Sorry, somebody got me on that. And I just don't trust them. And I never will in my life. I've never been rug pulled. I've never been rug pulled on like a line of credit or whatever. So it's not like I'm like biased on like, oh my gosh, I had a big call or whatever. It's never happened. But I see it happen to companies and I see how it can happen because I've been in talks with JP Morgan for loans. And then I'm like, man, why are you guys putting these terms in here? Like, is this normal? And then you get the sales guys with their British accent. Yeah, I can't do a British accent. But they're like, of course, sir. This is very normal. I can't do it. This is very normal. Just sign. Like, this is bullshit is what this is. I don't know. Sorry. Tangent. Get off of it, Kevin. Anyway. So where were we? Yeah, when you say they're breeding the cockroaches. Yeah, that's a good line. He's breeding them. He's literally, that's right. He's breeding the very cockroaches that he's warning the world about. That's shystery. Somebody says, this is why I love Kevin. Always straight to the point. Oh, well, thank you for saying that. It's not them. It's all banks. Dude, JP Morgan is like the bank of banks, man. And the thing is, they have the Federal Reserve by the balls, dude. And they know it. That's the thing. That's why they breed the cockroaches. Because then they could go, we warned you guys about the cockroaches while they're breeding the cockroaches, knowing the Federal Reserve will bail them out, but not everybody else. Too big to... Dude, these banks deserve to fail. There should not be too big to fail. It just leads to excess. Ugh. I hate it. Anyway, sorry. I got to get off that. I need a break.
Where some categories are seeing price increases.
Where's a blondie?
So a lot of the goods categories, particularly those that have a high import share. Think about all the toys that we spend on for our children.
Come on, baby.
Trusted traveler cards. like Global Entry and also U.S. Department of Defense.
Where's Taylor
ID,
Riggs? $18 fees for travelers without real ID.
Work.
I don't care. I don't want this guy. Where's Taylor Riggs? No Taylor Riggs. What is this? This is exactly the opposite of what I want to see right now. Fine then. So no Taylor Riggs. Where's Sarah Eisen? This is ridiculous. This will have to do.
An AI company, and many of these neo clouds have pivoted in that way, Dean. And lastly, I looked at KKR, for example. They're talking about potential froth in AI investment more broadly, and they're sort of trying to understand how the end user is using their data centers. But really, who is on the hook for all of it? They're trying to say, look, data center owners, operators, often it's going to be the leaser who is guaranteed long-term payment. Do we know who really has to hold the baby here and the bathwater?
I keep asking people the same question. You know, when the music stops, who doesn't have a chair? Because as you mentioned about debt, there's been, you know, large amounts of debt contracts, you know, financing of these GPUs. And if the GPUs are useful for less time than we think, what do the people that you know, are holding debt on them do? Do they ask for more collateral? Do they, you know, how does this all go? And you know, people that we spoke to did say that regulators and investors have to think about how far the, quote, contagion is going to spread if this all, you know, sort of comes home to roost at once.
Somebody says, does your wife know about your love for blondes? Yep.
We appreciate it. Lovely to have you in town amid this Thanksgiving holiday. We appreciate it.
All right. Cool. So what is this? Here is a T.S. Lombard piece. The Fed surprised markets with a hawkish pivot. That seems... Okay, hold on. Let me do this. That seems odd because 2 months earlier they were panicking about the trajectory of the labor market. It's true. What changed? The lights out at the BLS. There's no new data to provide reassurances. We think the Fed pivot was mostly a reassessment of the data already on hand. Instead of blaming weak employment on demand, there's now a group on the FOMC who blame the supply. U.S. employment has been lackluster. If you believe in the Phillips curve, as most U.S. officials do, this demands an immediate intervention, or they will soon be missing parts of their dual mandate. Okay. Ordinarily, the Fed would be chomping at the bit to cut rates. If you believe in the oops. Let's do fill color, nothing. There we go. Okay, and let's increase the size of that a little bit. There we go. Okay, if you believe in the Fed Phillips curve, this demands an immediate intervention or they'll soon be missing both parts of their dual mandate. Right, the change in employment. And yet the FOMC is divided with a significant number of members blaming supply-side issues because of immigration policies. Break-even level has collapsed to 30 to 50K. I actually think Powell's at 50. I think Powell is at 20K. And some are at 0 for break-even. So I think they're a little high on that. So I think they're a little off on that data. But that's okay. It shouldn't really be a surprise to see employment stagnate. In fact... I would expect the occasional negative print, something that's never happened in a healthy jobs market. Sure. What is this? Change in payroll 6 months after 6 months of zero growth. Oh, that's bearish. Oh, that's bearish. Oh, bear porn. Boys and girls, we found bear porn. Hold on a second here. Oh, the bear porn. I don't need that big of an arrow. There we go. That's awesome. You're up 91% by yourself, Mike, this year. Congratulations. Good for you. Good for you. Yeah, I don't make stock recommendations though, especially like, yeah, I mean, like I have top 10 stocks I like buying, you know, in the Me and Kevin Alpha report. And you can see when we talk in our live streams, you know, stocks I'm excited about right now. But yeah, you know, that's a big risk to go, oh, give me some stock picks. I'm gonna get in trouble if I answer that one. But yeah, you pay attention, you'll see where my desires are. Like, okay, so this is actually very interesting because if you look 1960, 70, 90, 74, 80, 81, 90, 2001, 2007, basically look at this chart. Basically, what is this left side? Change in payrolls after 6 months of growth. These are percents, I'm guessing. Basically, once we hit 6 months of zero growth, we're likely to go negative. Yeah, but the 3 month average has just picked up, right? Like our average growth rate right now, BLS jobs report. Let's go to St. Louis, employment, non-farm payrolls, edit, thousands, change, right here. Okay, so we're not really at zero. If I take this year to date, let's do it really quick, because I think this is actually quite valuable for all of us. And anytime you read stuff, by the way, you should be a little cynical and go through it. I actually think most of you are quite cynical, and it's a good thing. You're supposed to be. That prevents you from getting taken advantage of or ripped off, right? So, like, I know it sounds evil to be a cynic, but, like, you don't want to be gullible, right? That would be the contra to being a cynic would be gullible, and that would be bad. Jan, okay, so what do I got here? I got Jan, 102, 120, 158, 102, 120, 158. What's 158? 158 is April. Okay, then I've got 19, negative 13, 72. 19, negative 13, 72. Negative 4, 119. Negative 4, 119. October, NA. November, December. Okay. So my 3 month moving average is right here. This is my 3 month average of jobs divided by 3. Okay. Let's take this, kill that. That's my 3 month moving average. And then if I go to year to date average, and then let's do like a 6 month average. So a 6 month average would be 1, 2, 3, 4, 5, 6. And there we go. 6 month moving average of jobs. Yeah, 60. The 6 month and the 3 month average are pretty smooth. But if you notice, we're not negative or flat or 0. 5, 6, 7, 8, 9. And take this number divided by 9. Yeah. So this is actually not horribly unstable, right? So like if break even's 50, you know, if break even 0 to 20, we're beating, right? So it's not that bad yet. Obviously it's worsening, but I think it's too soon to make the argument that this guy's chart is of massive concern. But we'll write it down. You know, jobs, data. So let's throw in some averages. And then let's go back to that TS piece. There we go. Jobs. Okay, here we go. So, like, we're not though. We're at 50 to 60K average for now, right? So we're slowing, but we're not at 0 growth yet. Okay. Somebody says, Kevin is a wealth of information. Please hit like for his channel. Oh, thanks, Steph. Appreciate that. Okay, so somebody would say the best way to address this problem is to focus on the unemployment rate. If demand is falling faster than supply, which would warrant a monetary intervention, the jobless rate will rise. I mean, this is true. The joblessness rate can also rise because of participation And participation could rise. Early retirements could end, right? People could come back to work, which contributes to the rise in participation. Right? Okay, 3-month change in the labor force. Native-born, foreign-born. Oh, wow. Look at that. Look at that jump in native-born. Household survey looks a bit weird. Natives has increased. Wow. Wow. Pop in native-born. That's, you know, this somewhat suggestive the labor issues are potentially indeed immigration, right? So what do they say? Supply session head fake? No. Household data is dodgy. Population estimates are fixed, which means if foreign... Oh, they're saying if foreign drops, native goes up. This conceals the supply session. There are limits to how far this continue. Native participation rates are below... Oh, because it's calculated off the participation rate, maybe? I don't know. This is a little confusing. Okay, participation rates are below pre-COVID NERS, early retirements, we've talked about that. These workers aren't coming back. Well, that's potentially the idea. You know, because the idea here, remember, I think it was BCA argues that a stock market fall could lead early retirees to come back. Okay. Okay. No, native-born employment has not soared. Okay. In contrast, native-born and foreign-born populations are not predetermined by census estimates. They are not part of the population controls. Instead, nativity is based on survey responses. But the native-born and foreign-born populations must add up. Must add up to those predetermined totals for the population and control groups. Oh, if foreign-born responses drops for whatever reason, such as immigrants becoming less comfortable sharing data, the sampling is weighted. Oh, okay, so that's misleading. Okay, got it. So we'll say apparently misleading. All right, that's fine. That could be misleading, but we're still seeing, you know, that average employment growth certainly above zero. Pentagon says it's probing Mark Kelly. Okay. All right, so weak labor force growth has big implications for policy. Labor market is less likely to spiral against the Fed. The danger of hitting stall speed is reduced because supply-induced contractions don't feed on themselves. It's not like past cycles where some big imbalance had built up. Right. Supply sessions are not going to generate much disinflation. That warrants a cautious monetary response. Right, sure, because, you know, fewer workers... you know, how should you put it? Fewer available workers suggest less downward pressure on wages, which would be disinflationary. Break-evens, plausible range for the break-even, net zero. Yeah, but again, we're still well above that. I guess it just depends where it is. Break-evens. U.S. doesn't have a lot of experience with supply sessions. For 30 years, the business cycle has been dominated by fluctuations of demand rather than big shifts in supply. Right. Basically trying to say, like, we're in uncharted territory. Change in payrolls 6 months after zero growth. Well, that's the same chart as earlier. You can see why the Fed wants to proceed carefully. Right. All right. No landing. 67. No landing. Look at that. Inflation since the first rate cut, straight up after 1967. But didn't this have to do with, well, I know we had price ceilings there for a while, which exacerbated the issues. 1967 inflation. I think it was the policies. Let me see what Barron says about it. So, oh, not this crap again. Oh, maybe I can look at it anyway. 1967, the economy... Yeah, lets me read it anyway. That's hilarious. 1967 economy experienced softish of landings, growth around 6%, yield curve inverted, a recession didn't follow. Yeah, but not the 2's 10. Notably, blah, blah, blah. Some economists point to a guidepost for a similar outcome in 23. So this is an old article. Yeah, this is a 2023 article. So economy is overheating again. Inflation had surged. Fed funds rate, blah, blah, blah. Blah, blah, blah. So why? Unfortunate parallel between the 60s. 1960, such unemployment rate didn't rule out cuts. Benefit of hindsight. Blah, blah, blah. Labor market balance holds the key. Rather than place too much emphasis on unobserved concepts, policymakers should look at labor. Ratio of job openings. For an economy in balance, you should be at 1-to-1. Right. That's where we sit right now. In 1967, that was 2-to-1. Oh, interesting. Super tight labor market. Ah, interesting. Okay. That's extra. That's really good extra detail. Difference then, 2-to-1 jolts, just like what we saw in 2021, and then inflation followed. Now we're under 1. So that's less of a concern. Again, it always comes back to the labor market. Interesting piece, honestly. I like that piece. Okay. So what else is going on? Q's starting to roll a little bit. A lot of enthusiasm here. Tesla's holding, though. Apple, look at Apple just chilling out right on Kevin's line, baby. Right on it. Google's just bleeding. This is interesting. Keep in mind, it is not highly unusual for this market to, we get a big dip, which we had, and then all of a sudden you went to, what's it called? You get this big dip, and people then buy the dip, and then what? Well, you you start bleeding again after the buy the dip. Of the dip. It's a sort of dead cat bounce, and then you kind of keep moving in. I mean, that's unfortunately been what we've had over here. See, we've had plenty of bounces in the last few weeks over here. Plenty of bounces. If I go to unaveraged, I mean, you can see it here. Plenty of bounce days. Unfortunately, the trend has just been trash. So somebody's asking about Enphase. Don't worry, be happy. I like the name. Yeah, you have to remember that the situation for Enphase was a fantastic play when rates were low and things were cheap. Low rates incentivizes investing in solar. Great idea. Unfortunately, high rates, higher for longer, and the Trump crusade against solar has destroyed the play. You've lost tax credits. Rates are still high. China is eating our lunch on solar. So, now they're getting into power purchase agreement plays, which is terrible for Enphase because it kills their brand. I mean, so much has just gone wrong at that. So we've been bearish on Enphase for at least a year, if not more. We talked about it going back down to $35. I think it's even lower right now. Isn't it like high 20s? Yeah, dude, it's 26. Dude, that sucker's bleeding out hard. Anyway, what are they saying over here?
Thanksgiving approaches. Not that much time left to go in the year. I go back to what Tony Pasquarello of Goldman Sachs said last Friday pre-open.
Oh, what did he say?
He surveyed the landscape. He looked at the volatility and said it had some elements of capitulation. But he hasn't changed his overall bullish view. Quote, it's a bull market and the primary trend remains intact, the primary uptrend. Quote, I'm a believer that liquidity is set to improve. The economy should accelerate. The story may not be as pristine as it was, but that interplay is still pretty favorable. Does that match with how you think, Josh, about where we are?
I think it's a good take. I think the number one thing that you had to get right this
year. They don't care about your one thing.
That the worst is behind us. But does Main Street feel it?
We got a
And
Blondie.
Jonathan, that is the key question, along with
Oh,
if
look at
they
that red top today.
to
Maroon.
how consumers are feeling, because that's also been a little bit of a disconnect.
Yeah, I mean, I would say to Scott Bessent, from your mouth to God's ear, I mean, I truly hope that we do see a strong economy in 2020.
And this guy immediately starts talking about her mouth.
Of the average everyday American, Bank of America had a stat out last week. On average, 1 in 4 Americans is truly living paycheck to paycheck. That's pretty sobering. We talk about the economy as if it's something that exists on a spreadsheet. It doesn't. It's everyday Americans. And, you know, their money is simply not keeping up. Inflation still now been running above 3%, 2% for upwards of 5 years. So I want to be a bull, but I'm concerned about the state of everyday American whose bills and costs are going up.
Dagan, you've talked about real wages adjusted for inflation, accelerating, and, you know, Atlanta Fed GDP on Friday, the latest third quarter estimate for GDP growth is a whopping 4.2%. Now, we can debate that number because there's a lot of volatility with that, but growth should be the engine for higher wages to outpace inflation. What do you think?
And so inflation's running at 3%. Incomes are not going to outpace. You expect incomes to grow at 4%. That's hefty. Everybody is going to get 4% raises a year. Seems highly unlikely. I don't mean to seem so negative, but we have had for several years a speculation-based economy, even a gambling-based economy, where it was housing, stocks, and crypto, where people were willing to pay these exorbitant asking prices for homes. And home prices, stock prices, crypto going up and up and up made a lot of people feel quite wealthy. And when you have a plateau in that, which you have begun to see, or even declines or contractions in that, it leads to contractions in consumer spending. And I'm not even talking about the people who have been left out of this bubble, if you will. And so that has been the stimulus. A lot of the stimulus has been the explosion in asset prices. And just watching, say, cryptocurrencies and Bitcoin, that's going to have a major drag on consumer spending.
Kind of a leading indicator, oftentimes, right? I mean, they officially declare a recession long after the market or other speculative assets have already bottomed.
Interesting that's actually sort of the buy signal in many instances, people would argue. Jackie, in the introduction, we talked about Scott Bessent highlighting trade policy, tax policy, deregulation policy. The big, beautiful law was signed July 4th. Some of that was retroactive. You have other provisions that start January 1. So people are eager to start feeling the effects of that. Your thoughts?
I think they will. But, Scott Bessent better be right, because a lot of promises have been made and people are, taking notes on what those promises are. If you think back to the first George Bush, Papa Bush, no new taxes in his 1988 campaign, and then taxes came in 1990. He ended up losing the election, arguably because of that. It was a broken promise. I'm already hearing people say Trump promised that he would lower costs on day one. Now, he's lowered some of those costs, but certainly not all of them. And that's why people are feeling the pinch. He won't necessarily be running for re-election, but you've got the midterms coming, and a broken promise in that way.
I mean, they're not wrong about the consumer. The consumer is pissed. His prices are nuts for everything. Oh, I had to get coffee. All right. So what do we got over here? All right. So somebody says Taylor gives me Schmeagol vibes. Schmeagol? How do you get Schmeagol vibes out of Taylor? No. All right. So, U.S. equity star, blah, 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 mood, dovish tone from Williams. Yeah, we heard that. Evidence of weakening labor demand. Yes, we know, it's bad. Fiscal changes will boost that. That's the hope, right? The big hope is that this is the hopium. I'm going to write it down as hopium. Okay, hopium is deregulation, tax cuts, stimulus, rate cuts, all aid in 2026. See, they're even talking about the Fed now.
If there is a tariff, what that rate will be. So I don't want to say price gouging, and he did not.
Okay, sorry, I got to get away from this. It's too much. It's too much. Okay. So, Rorschach tests for the Fed, mixed labor market signals are unlikely to coalesce into a very divided committee. Path of least resistance could be to hold, but in a close call, Williams, okay, blah, blah, blah. No CPI data. Repo is eased. This is Deutsche Bank over here. All right, that's pretty boring. Let's see what other... Sometimes, like, often these institutional pieces are just boring. Let's see here. Equities, Russia, Ukraine, that's fine. CBOE. Barclays. Fed divisions run deep at ANZ, fine. What is this? America. Barclays Morning Research. What do you have for us? Nothing. Let's see. Oh, these are like individual tickers. Okay, whatever. All right, so the TS Lombard piece is interesting. Blah, 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 yeah. Okay. So, back to the Doomers for a moment. So far, so good. A nice bounce. Hopefully it's more than a dead cat bounce. Amazon to spend $50 billion to expand AI services to U.S. agencies. Oh, that's cute. Shill to Trump. Just go to dinner with him. Go to dinner with him and promise him donations, and you'll get your $50 billion contract. Suck up or shut up, as we say. All right. Dalio, Caribbean tensions. Tweeted about that this weekend. Nobody cares. All right. This is boring. That's boring. That's boring. The Journal. What do we have at the Journal? Let's see here. Big gap still left in bridge plan. That's fine. Talked about the Marriott situation, the Trump call, flood of AI bonds adds pressure to markets. I mean, yeah. Do you think banks failing in recession will increase or decrease the use of DeFi platforms? Oh, God. Will crater. Because, you know, all of the assets sitting on DeFi are mostly risk assets right now, which crater in a recession. Unfortunately, you would think that people would want to escape the banks in a recession, but, you know, that's just not how it works. These big plays, they usually get bailed out and then they just get bigger. Oh, it's crazy. Anyone that says the jobs market is good better not lose their job. It's a hellhole out there. One of my buddies has been unemployed for 7 months. Another one of my friends just got laid off. That sucks. Sorry to hear that. What else do we have? AMD is still rising, which is nice. The Qs are slowly rolling, but holding. Tesla's still holding. Again, you know, I think you're going to run back to that 414 pretty easily. Google tried to slow down its nonsense over here where it's been trading down the last hour and a half. All right. Let's see. Flood of AI bonds. What do we have here? Wall Street. Oh, yeah. Wall Street is straining to absorb a flood of new bonds from tech companies funding their artificial intelligence investments. This is what I love about, I mean, I keep saying it, but House High is like, we don't have bank debt. We don't have this giant debt problem. So let's see here. Somebody says, can confirm 2 months myself, hearing the same from many people. Wow, that's wild. All right, what else over here? AI data centers. Companies were able to start okay, stock investors nervous about sky-high valuations of AI businesses have taken note of the weakness in the bond market. Bond issuance, right. Wow, on a monthly basis. Holy smokes. Wow, we are look at the debt run up over here. Like, you had these miscellaneous little bond raises over here. Holy smokes, that's a turning point. Wow. Hold on a second here. The debt, this is actually way, I mean, when you put it like this is probably the most interesting chart I think I've seen on this. Screenshot this. Here's why, I'll show you. So put GPT on here, right? So you put a GPT logo on here, arrow, okay. So the GPT moment would be what? 2010, so that means 21, 22, 23, 24, 23. GPT moment was here. Right? So this was the GPT moment. Almost no debt, right? Almost no debt after it, right? Crazy. Almost no debt. You had a valley of no debt. Put that right there. Okay. And now, well, look at where we sit now. Debt has exploded. Last 3 months, what's the last 3 month total? Last 3 month total, we are at 18 plus 30 plus. Check out Grindr today. LOL margin calls coming. Oh no. 40. 88 billion. Hold on, let's go look at Grindr. Let's see if they have big pee-pee. Grindr down 10%.
Little PP. Little PP.
They don't know what the fuck they're doing.
Wow. Wow.
Pull up. Sync rate.
Jeez. Poor Grindr. Why wouldn't all these companies issue debt to build out AI and data centers? Why? They for sure will get bailed out by the government if there was a crash, and they know it. They can't lose to China. Maybe. The QT, I mean, the idea is that you could bring liquidity to markets by the Fed stopping QT. Ah. All right. So, okay, let's go back to that. This is fascinating because it really, last 3 months, you've had 88 billion in the last 3 months. So we're at the phase, okay? We're at the phase where as long as debt issuance continues, AI growth can continue. If labor stalls and debt issuance slows, private credit, liquidity, etc., we're gloriously effed. And I say that not wanting to be effed, okay? We do not want recession. It's very painful. But, you know, things would get cheaper. Okay. All right. That's crazy, man. The concentration of that makes me nervous, honestly. Because it's to me, this somewhat, like this sudden concentration has two explanations. And just so you know, I write this shit down because otherwise I'll forget. Like, sorry. Like, my RAM is not that good. I need a new SSD card. Or whatever. Disk. I don't know, whatever you want to call it. SSD. Solid state drive. Yeah, there you go. That and better RAM. RAM upgrade. I already have a bad graphics card. I mean, I have to augment my graphics like every day when I go drive. Or like when I fly. I need to augment my graphics card because it's so crap. Anyway, so where were we? The sudden concentration has two explanations. Explanation one. We're To make more progress in AI, we must spend substantially more, right? To stay ahead of China. To stay ahead of China. Okay. Or concentration of debt, right? Because this is of debt. Or two, or worse, companies are Oh, who knows what is, baby? Who remembers I'm I know you all know. In this context, it's out of money. But who actually knows what is? Oh my gosh, that's a horrible color. Let's use that. Yeah! There we go. Companies are Yeah. Alright, cool. There we go. Alright, some of you know. That's good. Gary knows. Aaron knows. That's an interesting one. Out of memory. Well, yeah. Pets Bud. What's up? Brent's in the house. Yeah, out of money in this case, but the gaming reference is out of mana. Out of mana. And if you're saying, what the hell is mana? You ain't a gamer. All right, so what do we have here? Personal income, PCE is scheduled. Oh, but that's the September data, rescheduled for December 5th. Nobody cares about that. That's not news. Markets are very interconnected now. It will be hard for credit markets to do well if AI stocks start falling off, selling off, and vice versa. Right. Yeah, no duh. Somebody writes, only old moms. Stop. Like I said, why would you spend your cash on that capex when you could issue debt and the government will bail you out? Yeah, I mean, there's some aspect of that as well. You know, it could be bailout belief. You know, I think that's a fair little note to make. You know, plunge protection / bailouts. Yeah, go bail out Blue Owl. Meta gets the upside, but limited downside, right? It's actually brilliant. Okay. So what else here? Investor enthusiasm about AI has been a powerful tailwind for markets, but in recent weeks have been tough with tech-heavy NASDAQ composite down, blah, blah, blah. If companies can bet on big AI to make profits, that would be good for their bonds, yes. Still, the most investors can get is regular interest payments plus their principal back. This makes bond investors especially attuned to the risks that outsized investments won't live up to the hype, right? There's limited upside in that. Recent pressure on tech company haven't been applied, buddy. Yield term premiums, Meta, slightly less massive cash hoard. Let's see. Yields going up. Despite carrying double A ratings, they now yield roughly the same as IBM bonds, which are single A rated. Oracle is in a more difficult position, already burning cash with plans to burn even more as they transform the company, or try to. Oracle could issue around $65 billion more over the next 3 years. Yeah, I mean, the debt bubble is really just now inflating. It just depends on how big it already is. Most investors don't think that even a sustained bond sell-off alone would do much to slow the AI build-out, given that money is no object for these big companies. Many, though, see a feedback loop between stocks and bonds continuing, noting how rising costs of insuring against Oracle defaults have gotten widespread attention. Default swaps, instruments associated with the Great Recession. Investors are broadly demanding more of a premium, means you're probably going to see less straight line growth out there. Well, sure, it's going to make bond investors a little bit more skittish. Let's see what the comments are. Recent Ray Dalio CNBC clip. Okay, I'll look at that. Top comments. LOL, how about GPT, a company with $12 billion in revenue committing to $1 trillion in investments? AI is pretty much a joke at this point. When you hear the sound of ice cracking, it's time to ski off the slope. Okay. So... Okay, let's go see the Dalio clip. I mean, he's always talking about a debt bubble, right? Let's go find out. Ray Dalio. Ray Dalio. CNBC. 4 days ago? Presumably it's this.
Our newsmaker of the morning, he's here joining us to discuss the markets, the history of economic bubbles, artificial intelligence, so much more. Bridgewater founder Ray Dalio is with us. Good morning to you, sir.
Good morning.
So you've been providing lessons for us for a very long time.
We'll just put this screen up while Ray Dalio talks.
What's going on? The big question in the market right now, because we're looking at NVIDIA this morning, and I think a lot of people are waking up thinking, where's the market headed next, has been this question of an AI bubble. And I'm curious where you ultimately come down. Are you with Jensen Huang, who says he doesn't see it that way, or do you see something else?
There's definitely a bubble in the markets. Bubbles, what is a bubble? Right?
Okay, what is a bubble?
What is a bubble? A bubble is that there's a lot of creation of wealth from various ways, such as you decide that you're going to have sell $50 billion worth of stock and value it at $1 trillion, or you have multiples like that, and then you create the wealth that way. And then the question with all this wealth relative to money is who needs the money. So it's a matter of who the buyers and sellers are. For example, if we had a wealth tax, or if you had a tightening of monetary policy, then there has to be the selling of those assets. So in order to pay those things. So there's a mechanics of who owns it, is it over-owned, and so on. It's not the long-term duration of the earnings. So you think about it, isn't it interesting that we have such a short-term reaction? It's great that what the results are, but this is it's valued as a long-duration asset. So for 25 years, the next 25 years, it's very unknown. We don't know what's going to happen, and bubbles don't happen because of good estimates of what in the future. It happens because of the need for cash. Do you sell that asset? Do you have to sell that asset for cash for some reason?
Well, that's the question, though.
So your book, I thought, did such a good example. I mean, I thought, by the way, your book is fabulous.
Oh, thank you.
But you take the 1929, and then you say, what made it go up and what made it go down? And that dynamic is the way bubbles work, right? And so if you take who has exposures, how much leverage is used, and so on, this is about 80% into a bubble that was 100% would have been 1929 and 2000.
So how much leverage?
Yeah, I mean, the big question is, like, when does it all turn around? And nobody knows. That's the tough thing. This debt issuance chart makes me nervous because it amplifies the risk factors. Let's see if Dalio ends up hitting that.
Leverage do you think is supporting all of this? Because we were talking to Partsenevelis in the last hour, and she was explaining this idea that Jensen Huang doesn't see a lot of the transactions that he's been doing. We were talking about these circular transactions where he's effectively taking an equity stake in some business, and that business is then committing to buy his chips, if you will.
Yeah.
A form of vendor financing with sort of a equity overlay, maybe, is the way to think about it. Do you look at that and say that's a problem? It's not a problem? Should we think about vendor financing in a different way? That was something that got a lot of the fiber guys in trouble in the late 90s, for example.
Yeah, I think it's an issue, but I don't think it's the main issue. I think the real issue is who owns the stock.
Okay.
Is it in strong hands? Not just one stock.
Right.
Isn't it amazing we're talking about one stock for the stock market bubble, and we're talking about for the economy bubble? So you have such a small percentage of the economy, such a small percentage of the American population in terms of wealth and so on, concentrated, and everybody in it, and in a leveraged way. In various ways, it has leverage.
What are strong hands? Like, how would you define that?
Weak hands would be the public.
So
In
retail
other words-
investors are weak hands.
Right. In
Strong
other
hands
words,
are the owners of these companies. The
right. In other words,
the
strong
executives
hands
of
is
companies?
that they
calling us weak hands.
Primarily invest their own money. You don't have public, right? The weak hands is largely, let's say, a leveraged public, and all united about that. That's one of the key ingredients of a bubble. So it's not just pricing, because we have to find out. Your book did such a great job of looking at the wonderful companies in the 1920s, and then it enumerated how electricity came out, and General Electric and RCA and so on. And those companies went down 90%, not because of the economy and so on. The bubble burst first because they needed cash. So you have to understand that wealth can't be spent. In order to get money, you have to sell wealth in order to get cash to get the money to buy things. And so when that happens, bubbles burst. So bubble bursting means, let's say, a tightening of monetary policy is classic, but also something like wealth taxes can happen. For example, think about wealth taxes forcing sales of assets that you have to.
And you're right. By the way, there's a proposal for a wealth tax in California right now.
Yeah, so state and national, right? State and national. I'm just trying to describe the mechanics of a bubble.
But you said we're at 80%.
Yes, I have a bubble indicator that goes back to 1900, and it just.
I like this. He has a bubble indicator.
It has a number of indicators. How much leveraging? Who has the leveraging? Is it what is the amount of money in wealth that relative to the amount of cash that needs to exist, and so on? These indicators, there are a number of them, show that we're on that chart. If I was to show you the chart, it's about 80% of where it was in those two times. That doesn't mean that that's the end of the move, okay? Because bubbles have to be pricked.
Right.
And so you can measure that there's vulnerability, a lot of vulnerability. There's a lot of vulnerability of who's holding what.
Here's my question to you about that, which is if the bubble is at this 80% range on your index or metric, there are folks, we had Paul Tudor Jones come in here a couple weeks ago, and he said, look, I think we're in October of 1999. By the way, the market would still have 40% to go. Back in 1928, Charles Merrill, who founded Merrill Lynch, told everybody, get out of the market because he thought it was a bubble. And he was right and he was wrong insofar as from the beginning of 1928 to September of 1929, stock market went up 90%. And so...
But I think that when you're looking at that, you're looking at it incorrectly, okay? What is a bubble is the definition, right? I want to reiterate, a lot can go up before the bubble bursts. A bubble is an unsustained set of circumstances. It has unsustained amount of buying. Right. It has an unsustained amount of valuation. It has, and then there's something that pricks the bubble.
Is there a way to sustain this, though?
You can't look at, don't sell just because there's a bubble. Okay? Don't sell just because of a bubble. But if you look at the correlations with the next 10 years' returns, when you are in that territory, you get very low returns. By
the way, JP Morgan just did a report on this that showed that if you got in at over a 23 PE multiple, typically over a 10-year period,
Under 2%.
Your return is a delta between 2% and minus 2% a year over 10 years.
Yeah,
which gets to your point.
I just put out today a post on this, and you'll see the charts and if you go on that. So I think that you have to say it's unsustainable. Then you have to go to the timing. What is it that pricks the bubble, right? Mm-hmm. Typically a tightening of monetary policy. We're not going to have that now, right? Mm-hmm. But you could have something. In other words, the need for cash.
Right.
The need for cash is always that which pricks the bubble. Because when...
That's a great line. Great line. The need for cash is always that which pricks the bubble. Yeah. Yeah, I agree with that. I mean, Yeah, I mean, it's an interesting way to put it because a lot of people have been looking for like, oh, well, what's going to cause the bubble to pop, right? So, kind of a good point. Well, I'll write that down. So, Ray Dalio says, what causes this bubble to pop, not when, is simple. It's a need for cash. Yeah, all right. I like that. A need for cash. Cool. Doesn't tell you anything about when. Instead, the Qs are still marching on to 607 right now. Pretty impressive. We might actually make it to 607 today. AMD is kicking butt. Amazon's turning back up. Apple can't get off the line. Microsoft slowly rising. Google's back on an uptrend. That's bullish for the Qs getting to 607, by the way. Nvidia's up. Bitcoin's moving. Nice bounce day here. You know, following the pain that we've seen like on Friday and the day before. So very cool. Next Nvidia lines, we really got to get to like 196. Yeah, so we're a little lineless over here. We're in the middle, no man's land.
Activity that they are bullish on, Scarlett. All right, good stuff. Thank you so much, Emily Grafeo, with our individual equity movers. Of course, we are also monitoring oil futures today. You look at WTI, West Texas Intermediate, slipping to as low as $57.42 a barrel as traders weigh the prospect of a Ukraine-Russia peace deal. Now, this is, of course, a developing story. President Volodymyr Zelensky's chief of staff says that significant progress has been made in negotiations, but allies are also saying sticking points remain. So here now to parse through these headlines is Bloomberg's national security reporter, Nick Wadhams. Nick joins us live from Washington. Nick, where do we stand in terms of the confidence that something will be forthcoming here? Because we've been getting mixed reports from both sides.
Right. I think the general expectation is that any deal is still a very long way off. So President Trump last week, his administration sort of threw a hand grenade into the trench with this 28-point plan that really went quite a lot farther than Ukraine would be willing to go in terms of the concessions that Volodymyr Zelensky's government would need to make. Now you're sort of seeing this wind back to a potential position where Ukraine would get a bit more of what it wants. But ultimately, this is not a plan that in its most recent form that Ukraine was supporting, that Europe was supporting. So, and then, of course, the other issue is, so we've had these conversations between the U.S. and Ukraine over the weekend where maybe they get back to a situation Ukraine's more amenable toward, but we still haven't heard from Russia. So what you see essentially is, again...
All right, still haven't heard from... All right, whatever. At least negotiations are going on. So Meta's got a nice move here, 3% on Meta. Qs keep rising. There's really little news today, honestly. MicroStrategy's got a little bounce. The only thing down today is Grindr. Grindr and some miscellaneous plays over here. Target down another 2%. Volatility down 10%. Oh, well, there you go. That's going to be one of the reasons why you're getting a nice little pump. Ethereum, look at that push. Ethereum now popping up. Went down to, on Thursday, we were down at 26. Now at 29. Nice. Good little move back up over here. Is that thing seriously doing it again? It is. That iPad's...
Something went wrong.
Yeah, shut up.
Please try again.
I don't understand why it keeps doing that. Open Door is rallying today. Rocket Mortgage is up 2%. What's this? Symbotic popping a little bit. 5% on Ubiquity. These are some big numbers here. Duolingo, though, keeps bleeding. We did some fundamental analysis in the courses on this one. Boy, what a U-turn of enthusiasm. I mean, it's like full, all the momentum just evaporated out of Duolingo here. Yeah, I haven't tried the sailing skill, I will say. Six Flags. Oh, look at that. Look at that bounce on Six Flags. I have a line here at 1228. It bounced at 1251. Up 5% today on Six Flags. Wow. Dude, this sucker has gotten so low. Look at this. This is the week chart for this. Holy smokes. What a disaster that chart is. It's so tempting to buy. Of course, you're totally screwed if you go into a recession. It's just like, that's bankruptcy, right? That's the downside of these plays, is they're cheap for a soft landing. If you go into a recession, it's like full blow bankruptcy, basically. Okay. Let's see if The Economist... not the greatest... Oh my god, I'm going to throw this thing away. Hold on a sec. I'm just turning it off. Shut up! I hate it so much.
Sorry.
Shut up! It's turning you off. So dumb. We're in the world of AI. They're trying to stream over here. Gosh. Drives me nuts. Alright, so where's The Economist? Economist, why investors are increasingly fatalistic. AI tokens, companies are losing their way, blah, blah, blah. What is this? All right, across markets, mood has shifted to fatalism. Stocks have been soaring for years, fueled by AI profits. Grand scheme of things, the recent sell-off is imminently bearable. Sure. I mean, it's not that much for stocks. But for stocks to fall when news is good is a troubling hint that the bull market may be running out of steam. Right, that's the question, is is this a dead cat bounce today, right? Traders are on edge. Coming week will be an alert to signs the sell-off may accelerate. One red flashing light. Let's see. Nvidia. Okay. Another warning sign would be, what is this? Vol, hedge against volatility, price of gold. Third, normal correlations. Japan. Blah, blah, blah. All right. Nothing. No news there. Hey, we're almost at 88K Bitcoin, though. Financial Times. Binance founder CZ accused of facilitating payments to Hamas. I don't doubt this at all. I don't think he gives a flying F as long as people are using Binance. In a complaint filed in federal court by American citizens whose families were murdered, CZ is alleged to have knowingly provided substantial assistance to Hamas and Hezbollah, money laundered through Binance. Totally buy it. Yeah, it wouldn't surprise me at all, because in interviews he has bluntly admitted that we're just not going to do KYC and we're not going to worry about who's trading on it. We're just going to facilitate. Trump just says had a very good telephone call with President Xi. All right, so Trump now pumping China. That should be bullish. Bump it. Trump accepted invitation to visit in April. Okay. All right. So Trump's going to China. I thought only Nixon could go to China. All right. Okay. Nothing on the FT, nothing on the info. What about the New York Times? We didn't even look at them yet today. Let's see. Epstein's story is so awkward. The real Epstein cover market. America's housing crisis in one chart. Ooh, let's see it. What is this? Americans still building fewer homes than it was before 2008. Duh. Old news, grasshopper. Old news. We don't build enough. You want cheaper housing? Build more. Core problem, too much money chasing too few homes. Every White House. Oh, did you see the Fed study, by the way, on rental owners? Oh, that was an interesting one. Fed impact landlords. Price. Where was it? I think it was this. Yeah, it was. Was it this? Impact. Right. There were the two aspects of this. So there are two types of investor-owned single-family dwellings. There's purchasing activity of the small-scale mom-and-pop investors who account for most of the increase in single-family rentals, as well as the one associated with the foreclosure crisis. Large-scale institutional investors, they represent a tiny, tiny fraction of the market. Like if we do landlord buy, properties owned, institutional, 2 to 4. There should be a chart on this. Let me see here. Images. I've seen the charts before. I can't find the damn thing. Most homes, investments, single family homes owned by quantity, institutional, homeowner. I don't know. I can't find the darn chart. This should save it. Major investors. Oh yeah, I mean there's one, and then there's there are a bunch of these. Investors. No. But anyway, this Fed piece was great. I'll show you this in one sec. Let me just see if I can get... yeah, there we go. Okay. That's one. And then... Okay. This is another good one, too. Okay. So here we go. These are great charts about the housing crisis. Judge dismisses case against James Comey. Wow. Judge finds prosecutor leading case against Comey unlawfully appointed. Oh. Comey case dismissed. Judge finds prosecutor leading case unlawfully appointed. Wow. That's interesting. Okay. Anyway, so look at this. This right here is an impact from the Federal Reserve. And they found that institutional investor-owned homes tend to increase the price of homes surrounding them. And this might be because institutional investors tend to buy dilapidated properties and renovate them after purchase, and or, theoretically, because they improve the quality of the neighborhoods. So that's actually a good thing. It sort of means that you're sort of like propping up the bad. Okay? And then they say there's a flip side. Look at this. In contrast, I thought this was so interesting. Mom and pop investors seem to have the opposite effect on property values. Small scale investors do not have the capital to spend on the neighborhood or renovations like large scale investors do. And renters tend to take generally less good care of the home than homeowner occupants, have lower incomes, and contribute less to the community. Right. So they make this interesting contrast here that small-scale investors hurt neighborhood values, whereas large-scale investors help them. And I'm like, huh, that's a very interesting dichotomy. The majority of renters would prefer to own homes, 71% of them. But many believe it would be difficult to obtain a mortgage. Okay. Let's see here. Okay, so that was neat. And then if you look at, I mean, that sounds reasonable, right? And then if you look at some of these charts, this is institutional ownership as a percentage of single-family housing stock. So institutional ownership is tiny. And then these are iBuyers versus like small-scale buyers. Small-scale buyers represent the bulk. This is pretty old news too. And then same thing over here. The small and medium, they take up most of the buying. These are just in some specific suburbs over here. But not a surprise. Okay, what else? So where were we with this? This all started because of the New York Times piece, which is right here. So Americans built fewer homes per 100,000 people than it did in 2005, 1995, 1985, 1975. Here's the single chart. Wow. Still trying to come back. Every White House since Obama's administration has recognized the need to build more homes. Housing is a hard problem to solve. Zoning and building rules are set at the state and local level. Kamala Harris proposed to build 3 million new homes and release a plan that no housing expert I spoke to thought could come anywhere near its goal. That's not a surprise. Federal housing policy is stuck in weak equilibrium. That's a fancy way to put it. Let's see here. Places build housing and the federal government will give renters $1,000 off their rent. Oh, okay. Stimulate. Or don't build the housing and lose access to federal grants. Oh, basically build and the federal government will subsidize your rent for you to encourage you to go build. 88K Bitcoin. Right. Mm-hmm. So homeowners and renters a check equally, but those ideas are trying to solve a hard problem. It's people who have homes, who have voices in local politics and planning. They often like their neighborhood the way it is. They don't want more traffic. Right. What's in it for them? Exactly. In fact, there was a really good NIMBY tweet that was circulating about San Francisco then and now. San Francisco then and now. Let me see if I can find it. It was a good one. Oh, I find it. I'll find it. San Francisco, assuming they spelled it San Francisco versus like SF. San Francisco. Great. I can't find it. Damn. I also think the search on X just sucks. Like, why are you not giving me the recent trending stuff on San Francisco? I don't understand. Maybe I'll never know. But anyway, it was basically a photo of San Francisco not changing at all. Like a certain neighborhood, right? I found it. Yeah, this was great. Look at this. San Francisco 1953 versus 2005. Or 25, I'm sorry. So look at this. This is 72 years later. It's exactly the same. The gas station on the right has a canopy, and the trees are a little taller. Otherwise, it's changed zero. actually kind of incredible. Pretty remarkable. Okay. So can't put this kind, let's see here. Can't put this crassly. Incentivizing renters to show up at local elections, renter friendly. I don't hate the strategy. If most renters show up in their primaries and demanded good things, maybe we could see different outcomes, but mostly renters don't show up because, you know, votes are driven by homeowner dominated. Yeah. Yeah. The other problem is that housing policy that does benefit a community will do so slowly. It takes years. Exactly. Unless you're in Texas. Then it goes really fast. Yeah, look at that. 79% of Americans say housing costs are too high. Only 24% think building more homes would help. How is it so retarded? 100% of people should think that building more homes would lower costs. How is that not like Econ 101? Increase supply, price go down. It's so simple. Yeah. Dude, offsite housing, this is, I mean, like Boxable's been a scam, right? I mean, we know about the Boxable scam. Those people got so mad at me. I mean, they exposed themselves. Let's see what the comments are. The New York Times comments. Let's see what it says. Watch, they're going to blame BlackRock. Dozens of these commenters are convinced that housing shortages are affected by Airbnb, second homeowners, or private equity or corporations. Yeah, exactly. See? Of course. Could you explain whether these are really significant factors or just another excuse? Yeah. I mean, the Airbnb bubble didn't help, although that's started bursting. Oversimplistic and lazy reporting, bad regulation. Here in Washington, a homeowners association can sue builders for construction defects up to 4 years after completion. Builders see it as inevitable they will be sued, so they choose not to build townhomes and multifamily and focus on ultra-high net worth single family. Yeah, makes sense. Fly in the ointment. You expect Congress to act. Yeah. Huh. All right. Good old real estate problems, huh? I don't think there is overbuilding. Somebody here is asking about overbuilding. I mean, we're literally looking at a chart that says we're underbuilding. You know? But yeah, I mean, lower immigration might help soften that a little bit, maybe. Hey, yields are really coming down, which is nice. TLT's at 90. The Qs, look at this. Marching, baby. 607. That's the goal. That's the goal today. That's bullish. Very good. Still slightly above 414 here on tests. Holding on to gains so far. Everything's really holding. Google's holding up. It's very good. Very good. Let's see here. Yeah, holding up nicely here. All right. What else? What else is to talk about? I don't know. I guess we could talk, like, you know, Graham had that really depressing video with building permits. That was right here. Oh yeah, this section.
As if that's not bad enough, it gets even more ridiculous. After requesting the 75-day exemption, 3 weeks goes by and another city inspector shows up at the property to take a look at the upcoming work. But instead of signing off on it, he puts a note on the file that in order to do the sewer line work, I also have to fix 22 feet of the sidewalk in front of the property that was uneven because of root intrusion because of the city-owned tree. That now needs to be addressed before I'm able to go and do the work on the sewer line. Oh, and by the way, to fix the sidewalk that's caused by the tree owned by the city, I need to obtain what's called a root trimming permit with the Urban Forestry Department. And that requires another 60-day approval process to trim tree roots. Why?
Yep, that's exactly why people hate building in California. It's so ridiculous. Like, you want to bang your head against the wall. It's so bad. Like, you can't blame the frustration there at all. Can't blame that at all. It's super, super annoying. So, let me see here. Let's see what else there is on... Housing, yeah, no, okay. Nothing here. Alright, let's see. Anything on Fox? No. Pretty boring. Okay, 10-year yield. How are we doing over here? Yield spread. Yield spread. 53. That's good. And then... if I go to bonds, down on the 10-year by 2.3, which is great. Okay, we looked at some of these bankruptcies. Flood of AI bonds, we looked at that. The AI bonds thing, that's a little concerning. Maybe we summarize that. Summarize a little bit of this real estate issue too, I guess. Okay. Let's do some summaries. Okay. Hold on. Let's make sure everybody's alive. Yep, everyone's good. Cool. Close that door. Let's do some summaries. All right. Who's ready? Somebody says BTC now vertical. What, did we hit another 400 bucks in there? Yeah, there's some really good dip buying happening right now. Yeah, look at that. Really, I mean, we were here a little bit ago. What do we, no, it's actually been a minute. When were we here? I was on the wrong chart. Last time we were here was on the 23rd, really? Oh, yesterday. Yeah, well, we were. We were here yesterday. At 88. But now we're breaking out of that 88 level. Nice. Nice little bullish reversal here on markets, huh? Enthusiasm. What's this?
Scheduled to be released October 30th. Those were delayed by the federal government shutdown. The September income and spending report, which includes the Federal Reserve's preferred inflation gauge, will be released December 5th. We're going to keep an eye on all of that for you as we check markets for you all day long here at Bloomberg. The S&P 500 up 1.6%. NASDAQ up 2.6%. The Dow up about 0.6%. The 10-year Treasury yield at 4.04%. The 2-year yield at 3.5%. Those stocks keep rising as we launch launch into this holiday-shortened trading week. Hopes are building that the Fed will cut rates at its next meeting in December. Fed Governor Christopher Waller told Fox Business he's advocating an interest rate cut in December, but after that, he says he expects a more meeting-by-meeting approach. Bitcoin began the week by continuing a prolonged sell-off, putting it on the path for the worst month it's had since 2022. The wider crypto market now in a pronounced slump despite surging institutional adoption and a series of policy wins. Bitcoin is now just a little bit higher, about 0.5% higher after being in the red all day long, still around $88,000. High turkey prices and low production creating a shortage of turkeys for food banks across the country. Turkey costs have soared, contributing to shortages, straining the budgets and inventories of charitable organizations. Now, the Department of Agriculture estimates turkey production at its lowest levels in 40 years. Wholesale prices forecast at about $1.35 a pound. Compare that with last year, it was just 94 cents a pound. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go.
Boring.
Remain restrictive even after a cut. And so where are we now on that roller coaster? 67% for a December cut right now. That's one of the more recent highs we've had. And then that same cut, well, it's got an 80% probability of happening by January. One way dissenters could be convinced to position the Fed, depending upon the data, for a January pause would be a January pause. Waller, a supporter for a December cut, suggested in an interview today with Fox Business that the Fed should go meeting by meeting in January. So call it, I guess, a hawkish cut.
It also feels as though they keep talking about this idea that every meeting is live and every meeting could be dead. It's all dependent on the data right now. We're starting to slowly get that data coming back online. So as we talk about the outlook for next year, it seems as though the predominant fear remains, and rightfully.
Boring.
Kind of go to what Jackie's saying. Do you feel like Mamdani's success is kind of threatening to pull President Trump his direction just a little bit?
Neither one of them are going anywhere. They're stuck. President Trump likes winners, and the guy won. And he mentioned it in the Oval Office last Friday. He's like, I was watching your numbers in the run-up, in the primary, where you were like, oh, single digits, and then he went
right through the numbers.
He was paying attention to the guy because he came out of nowhere, and he's now the mayor of New York City. Now he's got to govern, and President Trump will be the first to lambast the guy when he starts sucking wind. And if he sticks to these,
and also true. All right, so man. Yeah, I don't know. There's nothing super fun right now. You know? Honestly, it's like, yeah, there's a little bit of that in real estate, a little bit on jobs, debt, but not too terribly much today. So maybe we'll come back later, but I'm gonna go do something else. Good luck out there. I love y'all. See you soon.
Kevin's somebody we'd consider. Kevin is